Hi, everybody. Very good morning to all our friends in the States. Good evening to everybody in India. We have with us Mr. Nishith Desai, Managing Partner at Nishith Desai Associates. And we're going to have a short dialogue on the budget that was delivered earlier today. Nishith Bhai, the first question to you: what is your overall feel of the budget?
Oh, I think, as usual, budget speech is always meant to boost people's sentiment. But when you begin to read the fine print, which takes a few days, then you begin to realize what are the inside problems. So, generally, I would not make comment on day one, which would tantamount to an opinion. What I can talk is only some kind of reactions.
Sure.
So my take on the whole budget is that, and that's what I often say, is that it's a good directional budget, but I think it takes us into some kind of circuitous route, and sometimes everything is done well, but last one or two things, wrinkles are put in, and that causes some problem. So by and large, I think budget is very good, but there are few things, and especially that concern the foreign investors. I think we need to talk about that. And of course, there are few some. It's always a mixed bag.
Sure. So absolutely. So while we'll come to what the misses were, I think let's get on to a few of the proposals that were laid down. First being the reduction in the corporate tax rate. So what do you think about that? Could something else be done about it?
Yes, I think whole world is moving to reduce taxation. I believe Mr. Trump also is speaking about it. In the UK, also tax rates on corporates have come down, and we are talking the same language, which is a good news. So now, as far as the mid-sized corporates are concerned, that means the corporates which have revenues up to what we India call 50 crores. You know, that's close to about $7 million. Okay, um, they will be taxed at the rate of 25%. Now, the Indian corporate taxation system is such that there is a first level of tax on the companies, like which is classical system. So you pay 25% tax on the companies that have close to about, I'm just giving 7 million, it's 50 crores.
Right.
And they would pay 25%. So you're left with about, say, 75. If you have 100 income, 25% tax, you're left with 75. Then there is something called dividend distribution tax. That is additional tax paid by the corporation or company. And that tax is close to about 20%. So out of 100, you pay 25% tax. Now you are left with 75. This 75 is subjected to 20% tax, or close to 14-15%, 20 plus sometime. So you have that. Now, when the company distributes dividend after paying that additional dividend distribution tax, and if it is distributed to an Indian resident individual or a trust or some of those entities which are not exempt, then there is a third level of income tax, which is about 33%. So if the individual in India receives more than ₹1 million worth dividends from a company, then you pay additional 33% on that amount. So effectively, you pay 25% tax and another 33% tax on 75. Okay. So total taxation would effectively come to close to 48%. So I think that is pretty steep overall.
Right.
And that really we need to address. So to that extent, I'm happy that corporate tax rates have come down from 34-35% to 25%, but non-elimination of dividend distribution tax, or in addition income tax that is being paid by the individuals, uh, that cascading effect, I think, is not in sync with the global system.
Absolutely. I think that gives us some perspective on the reduction of tax rates.
Right.
But moving on, I think we have been seeing something on the the debt market in India improving, and there has been a reduction in interest rates also in this current budget. So, what do you have to say about that?
I think as far as the interest rates are concerned, I think India is going to develop a debt market. I think it's very shallow at this point in time.
Right.
And what has happened is that there are two types of debts, and especially let us talk in the context of foreign investors. One is what is called external commercial borrowing. That means when an Indian entity or Indian company borrows from abroad in dollar terms. So borrows in dollars and it has to repay in dollars. It's a foreign currency loan, and the interest is also paid in foreign currency. Now that tax rate is normally 22%, but it's been reduced to a level of 5%. It was reduced a few years ago, and that reduced tax rate was now almost coming to an end in 2017. So that is extended to 2020.
Sure.
So up to 2020, the tax rate on foreign currency borrowings would be about 5%. Then we got something interesting called masala bonds. So where the borrowings are done in rupee terms. So Indian investor, even though he may receive dollars, but his obligation is to pay back in rupee terms. And that is taxed also at the rate of about, currently rupee bonds, or rupee denominated loans and the interest paid on that. Interest was taxed almost close to 45-46%, and it was reduced, it's reduced to 5%.
Right.
So now foreign currency borrowing and the Indian currency denominated borrowings, both when you pay interest, would be taxed at the rate of 5%, which is, I think, a good sign. And as I told you, in first case, exchange risk is on the Indian party. On the masala bond, the exchange risk is on the foreign party. So that's but that's a good news. That's a good news.
Right. Okay. And I think one of the issues that has caused a lot of hue and cry in the past month has been the indirect transfer on the FPIs. So I think there is some clarification that the minister also has brought to that. What is your take?
Right. Then the indirect transfer, let's first understand what that means. Basically, this indirect transfer provision came in after Vodafone case, where the foreign company owned the shares of Indian company, and when the transfer took place, that was the shares of a foreign company outside India. So technically, this is a transfer of shares outside India between two non-residents, okay, of a company, foreign company, which has shareholding in India. So the tax department in India tried to say that, okay, even though you are transferring foreign company shares outside India and that transfer is between two non-residents, indirectly you are transferring interest in Indian company and we are going to tax you that in India. But the law did not permit, and Vodafone won the case. All that is a history, and government changed rules with retrospective effect. Again, that a lot has been talked. I won't go into details, but that is where retrospective amendment was brought in to say, okay, when you transfer shares abroad, even then, if you had any interest in India, we'll tax you. But it led to a lot of complications, and therefore now foreign portfolio investors, okay, have now been given exemption. There are quite a few other detailed rules. Some of the exceptions are there, but in general, this particular amendment says that if you happen to be a foreign portfolio investor, kind of an investor who usually makes investment into Indian public companies, okay, and if the interest in that foreign entity is redeemed or is transferred, so to say, then even though there is some kind of indirect transfer, the indirect transfer rules will not be invoked. So that's some simplification for the some of the foreign funds and foreign investors who classify or categorized as FPIs, foreign portfolio investors.
All right. I think that gives us some perspective of the indirect transfer also. So I think coming to what was missed, I think one discussion that we have had over the past year has been the equalization levy.
Yeah.
So what is your take on the equalization
You're
levy?
touching my favorite point, I think. Now, uh, you know, taxpayers are creative. Tax gatherers are also becoming more and more creative. So, what has happened last year? The tax department came up with an idea of what is called sometimes called Google tax kind of thing, and they called it equalization levy. Now, this equalization levy is imposed on an Indian entity or Indian company that makes payment for online advertising. When Indian entity makes payment for online advertising, there is a 6% tax that has been imposed on that payment. Now, basically, this tax is on the foreign company, but obviously they are not going to bear it. So they are going to transfer it to the Indian entity. And some cases for temporary purpose, they may not collect it, but in long run, they could not. So 6% on the advertising services, the payment that is made. Now, this tax is not classified as income tax, nor it is classified as service tax or what is called goods and services tax that is being proposed. So it is a third kind of a tax. So you got one side income tax, second side this goods and services tax, and this equalization levy. Now, if they would have classified this as goods and services tax, at least they get a set off. And we are going to have goods and services tax come into effect in India sometime from July onwards. And no, we do not know what kind of rates are going to be there. But what is being talked about, it could go to 22%, or some cases 26 or 28%. So the thing is that in addition to that, if you impose this 6 or 8% tax, it goes to about 36%. So this rate of tax, which is 6%, is also likely to move up to 8%. And as a result, the effective tax rate could be 36% on the payment that are made for online advertising. The issue is, how is it going to impact the startups? The startups basically spend almost 40% of his budget on online advertising, because that's the only way it can go reach out to the world. So when you have a budget and 40% of that budget is spent on online advertising, and on that you are going to put 36%, possible, I'm not saying it is. Currently it is close to 22%, because 14-15% will be service tax and 6% is this equalization levy. So it comes to about 20-22%. But quickly this will move to 8%. And then goods and services coming in, you don't know whether it will be 18%, 20%, 25, 28, whatever it is. But up to about 28 is a maximum. That is what is. So if you take minimum impact of this, could be anywhere in the range of 28-30%. Higher side could be about 36%. So 40% of startup budget, if it is going to be taxed at the rate of, say, out of $100 that you raise, $40 go for online advertising. On that, you pay 36% tax, highest.
Right.
Okay, it's a nightmare. Number two, that this 6%, which is likely to go up to 8%, is imposed currently on online advertising, but it is likely to be expanded and to even cloud and other kind of services as well. So 8% and all that. So yeah, almost 60-80% of startup budget, could be taxed at the rate of anywhere between 28-29% to 36%, and that causes a lot of concern. And so, as someone who is really passionate about startup, this is something that I have been making a little noise about. Hopefully, let's see how government comes up with. At the moment, we have suggested to government not to impose this tax, or even if they impose, let it be part of GST or income tax. At least somewhere you get a tax credit. That was the idea.
Sure. I think just by one point on the interest again, now that we have something called the thin capitalization rules,
Mhm.
what is your take on them?
I think once again, this expressions like thin capitalization, they are technical expressions, and it means where you have a small capital base in a company and large loan or debt inside. Now, often this system helps or encourages more debt pushing. So, what typically happens at times is that when you have a company, and if suppose I own a company, I put small capital in the company, but additional amount, large amount, I will put in by way of interest or by way of debt. So the consequence is, suppose Indian company has to pay this 25% tax, right? Corporate tax I treated in the beginning. Now, on 100 rupees income, I pay 25%. Now, if I have to invest in the company and say I have to put 1,000 rupees, okay, then what would happen is that instead of putting more capital, because when you put capital, you get dividend. Dividend is not a tax deductible item in the hands of the company which is paying. If it pays interest, it is deductible. So instead of putting equity investment, I will now loan to the company which I control or I have interest in, and on 1,000 rupees I will get 100 interest. I can write off all my income, pay no tax. Okay. Number two, if particularly I'm a foreign investor, then the interest that I receive from Indian companies is also kept at 10% or so. So on the one hand, Indian company pays no tax, I pay only 10% tax and get away. And therefore, these rules relating to thin capitalization are brought in, whereby now if Indian company is say excessively capitalized, and if it pays interest in excess of 30% of so-called EBITDA, okay, then excess interest will not be eligible for deduction in the hands of the company. Nevertheless, it will be allowed to carry forward in the future years. You can deduct, but in the 1 year, you will not be allowed to, write off all your income and uh, go home. So this is called thin capitalization rule. Those are being now introduced in India.
All right.
Yeah. But one of the problem is that this generally thin capitalization rules are applied only in the context of related parties or what are called associated companies. So where two entities are related, because you can manage your transaction between your related party. So that is why these rules are brought in. But our definition of associated enterprises or companies is little expansive. It also includes if some third party has made a loan, significant loan, which is say in excess of 51% to Indian company, then when Indian company makes payment of interest, that is that party is also considered related party because it has given money to Indian company more than 51% of its capital. So this thin capitalization rule will also extend to what you call, really speaking, not related parties,
Right.
but simply because they try to help a company and give a little more capital, they become related party. So this is something possibly, it was done in the context of transfer pricing regulations, but the same definition has been extended for thin capitalization rules, and I think some adjustment may be necessary in that case. That would be useful.
All right. Yeah, I think that's a helpful understanding of what happened today at the budget. But any final concluding remarks, concluding comments, you'd like?
I think what I feel is that while a great deal of effort has gone in, there are quite a few other changes that have come in. We are not going to go in great detail, but one interesting development that has happened in this budget is that government has said the approval process be cut down for foreign investment, and we have something called Foreign Investment Promotion Board (FIBB), to which the proposals for investment in India, you know, go up and for consideration, and they approve. Now, that entire approval process is now being dismantled because 90% of the approvals go under automatic approval. but still you have to keep on going back to FIPB and all usual bureaucrat stuff. So what government has done is they are going to dismantle FIPB, okay, and any foreign investor can come into India and simply invest and only does minimum formality by filing some forms with the Reserve Bank of India, etc., but no approval required, which is a great news. So that is one important development that has taken place. There have been some special concessions given for the affordable housing and the investment in it. Again, we don't want to go too much into detail, but India is in a dire need of affordable housing, and that's where, of course, the opportunity for foreign investors also arises. And there is going to be broadly, I think, there is a strong move to go after the black money,
Right.
and a lot of discussion in the budget has gone around that. India is moving towards digital economy. I think India is fastest adapter at this point in time, digital economy. Also, a lot of e-governance is coming up, and so I think we are moving into a different phase now. But I hope that some of the wrinkles that we talked about uh, earlier, if we clean up them, that will be very, very helpful. And I think another interesting one small point I forgot to mention about startup. And see, current law, like in the US also, it does exist, I believe. And that is, if a startup or a company which has been incurring losses, if it changes more than 51% of its holding, okay, so it gets transferred, then the previously carried forward losses are often not allowed to be carried forward. But for startup, an eligible startup, now it has been provided that if the shareholding changes, doesn't matter, so long as the founder or the founders or the original investors continue to stay in the company. Okay, so if they continue to stay in the company, then the carry forward of losses will be allowed, even though the 51% of the shareholders do not remain the same, because new investor may come with premium, they may put more money, whatever it is. So initially somebody may bootstrap a company, then it can reduce his holding, and if it goes beyond 51%, this was a problem, that all the losses were written were not allowed. But now that is what is going to be allowed. But this was very important point, I thought I'll make it. So the government is trying to mobilize startup ecosystem, but these wrinkles, particularly equalization levy, I think is very concerning, and that actually often encourages foreign investors to suggest to Indian entrepreneurs or others that why don't you incorporate outside India, maybe in California or in Singapore, which has become another problem, or Mauritius or any other third country than India, because then equalization levy may not apply. And but we don't need to have this kind of rules. We can possibly simplify the whole thing. People have no problem in paying taxes, okay, more so now with the taxes coming down. But there's multiple levies which are not offsettable or say creditable, you know, then you have cascading effect, and it increases the doing business in India. And so I think those are some of the things.
Okay. So, thank you, Nishith Bhai. Thank you,
Okay,
everybody.
thank you very much.
You're welcome. So, guys, if you want to reach out to us or any questions, there is an email address that is flashing on your screen right now. Do reach out to us, and we will be happy to help you.
Yes, but I forgot to tell you that we also have a webinar coming up, right?
Yes, absolutely.
So, what to tell? When is it?
Sure.
happening?
February 3rd is the webinar. We have the webinar in the morning and the evening concerning, we've taken into account your timelines. You will receive an invite shortly, and the invite will also be on our knowledge site, www.nishithdesai.com. Do visit us there. You will find much more updates and much more details about the budget in the next few hours. Thank
And
you.
also, we are doing something in New York, right?
On February 7th, yes, that was.
So let's.
Right.
I think on 7th there is a kind of event which will discuss in more detail the budget proposals and many other developments that are taking place, and we'll be happy to let you know. Just visit our knowledge site. Instead of website, we call knowledge site because there's a lot of knowledge you get in there.
Right.
And if you visit that, you'll find it. And if you have a problem, just write an email to me, Nishith at nishithdesai.com. That's as simple as that. And we'll send you out to you an invite. Thank you very much and have a good day.
Thank you.